Hi guys, welcome back to the Financial Interest YouTube channel. My name's Dan. So in this week's video, I'm going to continue with what I've been doing for the last few weeks and look into options. But this time we're going to take a slightly different approach. Rather than looking at options from the trading perspective, we're going to kind of incorporate options into actually a long-term investing strategy. And there's some really cool things you can do with options. And in this video, we're going to look at selling put options. And this is like pretty much offers you like a win-win strategy when you kind of combine it with the long-term investing approach as well. So let's get on with the video. So first we need to cover what is a put option. So a put option is a contract that gives the owner the right but not the obligation to sell shares at a specific price during a specific period of time. Now, if you didn't see my previous video on an introduction to options, I'll leave the link for that at the end of the video and in the description as well, and you can check that out because that will kind of give you a bit of a grounding in some of the terms that we'll discuss in the video. So let's take a look at the options matrix quickly, just so we can see how the buying and selling works for puts and calls. So we can see in the bottom right corner of the square, we've got the obligation to buy shares. So as the seller of the put option, we're obligated to buy shares at the strike price from the person who bought that contract from us. So we receive the premium which they paid to us for us to guarantee that we would buy their shares at a fixed price. So for the buyer of the put option, this would be a bearish trade because they think the stock price is going to go down. So now we're just looking at a slide showing an example of an Apple put option from the buyer's perspective. So I've highlighted the dates in the slide, so you can see that the contract starts on April the 16th, ends on May the 21st. The stock price on day one is 134.16. We've selected a strike price of $130 here, and we paid a premium of $3.20. This means our break-even price would be 126.8. So the price needs to drop to at least that for us to start being profitable as the buyer. And we can see the best case scenario here. If we manage to catch it at exactly the bottom, we would be able to buy shares at 122.77 and exercise our right to sell them at 130 per share. So this is how we would make a profit as the buyer of the option contract. And if we're an investor who owns the stock, this is hedging our downside risk, which is basically the same as buying insurance. So here we're actually going to be on the seller's side. So let's take a look at the key points of when we're selling options. So when we sell an option, we receive the premium and then we're obligated to buy the shares at an agreed on price. And the most we can make from selling an option is the premium that we actually receive from the buyer. So that's our maximum profit on the transaction. And our maximum potential loss would be the strike price minus the premium which we've received. And this is going to be our total risk in the trade. So we can quickly take a look at an example of this. So as the seller of the put contract, our aim is for the options contract to expire out of the money. And in this case, that means we get to keep the premium from the one contract, which is $320. So as the seller of a put option, our maximum risk is the strike price minus the premium which we've received. So here we've got the strike price of $130 minus the premium which we received, which is $3.20. And that leaves us with a total risk of 126.8, and that's per share. So then we need to take the 126.8, multiply it by 100 because that's one options contract, and that leaves us with the total risk for us on this is $12,680, and that being based on the fact that we have to buy the shares at that price. But this is where it gets a little bit interesting. So what if we actually wanted to buy the stock at that price? And this is where we're really matching up the long-term investing ideas with the options trading as well. And this is something I learned from the Rule 1 workshop. from Phil Town, and I believe he learned it from Warren Buffett. So this is not a new strategy by any stretch. It's been kind of around probably as long as options have. Obviously, these things have just become more popular with the growth of the derivatives market in recent years. So now we're kind of joining our long-term investing mentality along with our options trading as well, and we're going to use those to complement each other. So let's kind of have a look at the process and the things we need to know before we actually go on to execute a trade like this. So first thing, of course, kind of goes without saying, but we really need to understand how options work. So I'd recommend taking quite a long time to kind of familiarize yourself with this, and also definitely spend some time paper trading in your brokerage, just so you can kind of get used to the way it works and the kind of mechanics of it, because it's very easy to just hit the wrong thing and end up buying something instead of selling it. So after we figured that out, we also need to look at our long-term investing strategy. So we need to do deep analysis on the company, which is the 4Ms, as I've discussed in previous videos which I've done. And what we're aiming to do here is calculate the intrinsic value of the company. And of course, once we've got the intrinsic value, we apply our margin of safety to the valuation to get our buy price. And then we use the buy price to actually go and look at what price we need to enter the trade at, or what strike price we're looking for in the market. And of course, a critical thing to this is remembering that one contract is worth 100 shares of stock. So you will need to have enough money in your brokerage account to cover the 100 shares of stock. So obviously, if the shares are, the strike price is 100 and you need to buy one contract, then you need to make sure that you've got $10,000 in your account in case those shares are assigned or put to you. And that's kind of another way I like to think of puts. Puts when the stock is actually put to you, so you need to buy that stock. You're obligated to buy it as the seller. Okay, so here we are now in Think or Swim, and we can see we've got the options up for Facebook, and this is the options expiring on the 16th of July, and that's 25 days from now. So here we can see we've got on the right, this is our put options. So we can see currently the share price is 332.29. So this is the point here now where we're at the money. And you'll see here we've got the mark. So this is going to be the premium. So if we're selling the put option, this is going to be the premium which we receive. And you'll also see on here they've got the probability out of the money. So you'll see as we move further away from the money, obviously the likelihood that it's going to finish out of the money increases. And while that increases, you'll see the premium also decreases, because there's actually it's less likelihood that that's going to happen. So what we're aiming to do here is to actually let's imagine that we think Facebook is worth 320, and that is our margin of safety price. Now, I'm not saying that that's actually what the price I've calculated for Facebook. I just wanted to give a number so we've got something to look at on here. And actually, this works better when your company is actually fairly close already to its margin of safety price, because then you can actually make a decent premium as well. So here we've got the 350. So that means we're going to receive 350 per share. So we need to multiply that by the multiplier, which is 100, and that gives us the amount of $350. And I'll just show you what it's like here. So in this Think or Swim, you right click here, and then we are looking to sell a single, and then that will pop up here, giving you the information about it. This is the number of contracts. This is the ticker symbol, like the date of expiry, strike price, it's a put option, and the pink means it's sell. If we were to go and look at something different, for example, we wanted to buy it, then this is actually going to become green. So you'll see now we're buying the put option for Facebook. So it's very like you need to make sure you're clicking the right thing here, or you can end up placing the wrong trade. So we can see here the 320, we're looking at $3.50, and that's because we're 25 days out. And obviously if we change the options contract and look at a different time frame, we can jump into, let's say, December. So in December we're 179 days out. Scroll down here and we can see here that the premium there is actually $21.5. And of course the reason for that is it has a lot longer time period. So this is all to do with the time decay. So it has a much longer time period to actually reach that amount of 320. And that's why the premium is higher. But what you kind of want to do is actually calculate the premium on an annualized basis. I'm not going to kind of go over that in the video, but you need to look at whether $21.50 over a period of 179 days is any better than the $350 over a period of 25 days. And that's what you should be doing when you're looking at this. You're looking for basically the options trade, which gives you the best return. So now looking at the outcomes, we've basically only got two outcomes which can happen here. Either the stock never gets into the money and the contract expires worthless, in which case, as the seller, we keep the premium. So we've just earned ourselves money for really doing nothing. All we're trying to do is enter into a position with a company we want to own anyway. And the second outcome is if the share price actually does get into the money and then we get assigned the shares, we're actually buying the shares of the company we want to buy at the price we want to pay for it anyway. So this really is a win-win situation. And now let's just cover the key points from the video. So selling put options is a great way to earn income while we wait for our company to reach our desired buy price. The premium received can be used to actually bring the price down to our buy price and within our margin of safety. If the price never gets into the money, then we simply keep the premium, so we win there. And if the price does drop into the money, then we will get put the shares and have to buy all of those shares, which would normally be the risk. But in this case, we actually want to buy them, so we win there as well. And the key point here finally is we must have the funds to buy the shares if they are put to us, and remember that one contract is 100 shares. So as long as we fully understand how options work, and also we can kind of do the research on the company to make sure that we've done all of the analysis there, this is something that really pairs together well and gives you like a great way to enter a trade and also actually make some income while you're waiting to get into your company as well. So this is like one of the really good strategies to actually use for this. So that's it for the video. I hope you enjoyed it. If you did, please give us a like. Also consider subscribing to the channel as well if you haven't already, to keep watching more content like this, and hit the notification bell as well to get notified of when I release new videos. Also let us know any comments you have. I'm always interested to know kind of the different ways other people trade. So let us know down there, and thanks for watching, and I'll see you in the next video. Cheers.